Hey everyone. As you've likely already heard, last week the Federal Reserve raised the overnight rate by another 75 basis points. That's their fifth rate increase this year and their third 75 basis point increase in a row, taking the overnight rate to the 3% to 3.25% range. This aggressive effort by the Fed to get inflation under control was telegraphed, and it wasn't any surprise. The most recent inflation numbers delivered a couple weeks ago placed the headline rate of inflation at 8.2% and the core inflation rate at 6.3%. It looks like inflation may have stabilized, but there are no signs that it's coming down yet. There are, of course, a lot of factors in play. On the supply side, the war in Ukraine has cut the availability of oil, natural gas, and food. China's zero COVID policy intermittently shuts down entire cities, often stalling manufacturing or shipping through major ports. And ongoing transportation challenges by sea, rail, and truck have slowed the movement of goods, and so on. The strength of the U.S. economy is on the other side of the equation. The unemployment rate is just 3.7%, and there are 5.2 million more job openings than there are people looking for work. Wage growth has been above 5% for 8 months, and there's $23 trillion in savings, about $5.8 trillion more than before the pandemic. As a result of these forces, trucks are still moving 0.5% less freight around the United States than it was before the pandemic, while inflation-adjusted core retail sales are about 20% higher than where they were before the pandemic. Manufacturing, shipping, and logistics systems simply cannot keep up with consumption. The Fed's answer to this is to try to cut demand and get it back into alignment with supply by raising interest rates. Unfortunately, this will, as Powell said, cause some pain. In a nutshell, the Fed's basically suggesting the economy may need to go into a recession to get inflation under control. In addition, the Fed telegraphed rate hikes of 75 basis points in November and 50 basis points in December, taking the target overnight rate to the 4.4% range. The impact of the rate increases on real estate are most apparent in the single-family market, where home sales have fallen by about 28% since January. But the impact on the commercial real estate market is also beginning to emerge, most notably in the expectation gap between buyers and sellers. When the market makes a transition, buyers and sellers often see the market differently. Sellers tend to be slow to adapt to a cooling market. Many continue to shoot for top dollar when they sell and often end up chasing market prices down. But buyers are completely changing their underwriting assumptions. At the beginning of the year, investors could get financing in the 3 to 5% range, depending on the asset, location, borrower strength, etc. Today, the rates are running in the 5% to 7% range, and they're likely moving higher. As a result, the buyer-seller disconnect has widened and commercial real estate transaction activity has begun to slow. Based on last week's Federal Reserve guidance and positioning, I suggest motivated sellers recalibrate their pricing to meet the market. Meanwhile, buyers can take this opportunity to target strategic acquisitions to position for the next growth cycle. Any Fed-induced downturn should be mild compared to the last 2 recessions. But considering the stock market is down sharply this year, more than 20% so far, commercial real estate may be one of the best investment options as the Fed grapples with inflation and creates some economic turbulence. Now is when investors should be thinking longer term, where they want their portfolio to be in 3 to 5 years. And as always, investors need to keep their eyes on the horizon.